The live intraday price for Springview Holdings Ltd, trading under the ticker SPHL on the Nasdaq, is currently sitting at $16.70 USD. This represents a staggering intraday surge of 14.45 points, or roughly 642.14% in a single session. To put this into perspective, we are looking at a stock that opened the day at 7.82 USD and is traded as high as 21.40 USD. This kind of explosive movement is rare even in the volatile world of microcap stocks, and it immediately shatters the expectation that this was just another struggling construction play from Singapore. While the common narrative around Springview has been focused on its battle to stay listed on the Nasdaq and its recent reverse stock split, the reality is that a specific strategic pivot has ignited a massive curiosity loop among traders today. When you see a 600% gain, the immediate reaction is to look for a buyout or a major earnings beat, but the reality here is more nuanced. Springview just announced a memorandum of understanding with a China-based solar technology firm, Jiangsu GSO New Energy, to bring residential solar solutions to Singapore. Now, on the surface, an MOU is just a non-binding agreement. Usually, the market treats these with a grain of salt. However, because Springview is such a low-float stock, having recently consolidated its shares through a 1-for-8 reverse split in December 2025, it doesn't take much buying pressure to send the price into orbit. The expectation was that Springview would continue to grind along as a traditional design and build firm. The reality is that they are positioning themselves as a gateway for green energy in the Singaporean residential market, and speculators are betting heavily that this is the beginning of a much larger shift. This price action today is a classic example of what happens when massive volume hits a tiny share float. We are seeing tens of millions of shares trade hands for a company that just a few weeks ago had a market cap that wouldn't even buy a luxury penthouse in the markets they serve. While investors on platforms like Robinhood or those using interactive brokers are likely seeing SPHL at the top of the daily gainers list, it's vital to look at the institutional context. Before today, institutional interest was practically non-existent. This move is being driven by retail momentum and perhaps a few high-speed trading algorithms reacting to the keyword-heavy news of solar and strategic partnership. If you're managing an individual brokerage account or using Schwab Intelligent Portfolios, you know that this kind of parabolic move often ends in a sharp correction. But for now, the momentum is the only thing the market cares about. Let's talk about the disconnect between expectation and reality regarding the company's financial health. Most people looking at SPHL see a company that was recently facing delisting. In late 2025, they were under the gun from the Nasdaq for failing to maintain a $1 bid price. They managed to regain compliance by performing a reverse split, which technically fixes the price but doesn't change the underlying business fundamentals. The reality, however, is that they have been quietly cleaning up their balance sheet and seeking asset-light ways to grow. Their recent moves, including an exclusive timber distribution deal earlier this month and now this solar partnership, suggest a management team that realizes they cannot scale through traditional construction alone. They are trying to become a diversified building services platform, which has higher margins than just swinging hammers and pouring concrete. The volume today is truly the lead story. We are seeing trading activity that is hundreds of times higher than the 10-day average. When a stock goes from $2 to nearly $17 in a few hours, it creates a vacuum. Short sellers who were betting on the company's continued decline are being forced to cover their positions, which adds even more fuel to the fire. This is where the tension between expectation and reality becomes most visible. The bears expected a slow fade into irrelevance. Instead, they got hit with a solar-powered freight train. Comment below how many shares of SPHL you currently hold, or if you're just watching this madness from the sidelines. I'm curious to see who actually caught this move. To understand why this is happening now, we have to look at the Singaporean market. Singapore has been aggressive about its green plan for 2030, and residential solar is a massive part of that. Springview has been operating in Singapore since 2002. They have the relationships with homeowners and the regulatory know-how. By partnering with a Chinese manufacturer like Jiangsu GSO New Energy, they are essentially trying to plug a high-demand product into an existing distribution network. The reality that most investors miss is that Springview isn't building the panels. They are the last-mile delivery and installation partner. This limits their capital risk while giving them a piece of the burgeoning ESG investment pie. Before this solar news, Springview was a relatively straightforward construction and project management firm. They handle everything from design to furniture customization. They've had their wins, like winning heritage redevelopment contracts in Singapore, but the construction business is notorious for thin margins and high overhead. The asset-light strategy they are now touting is an attempt to escape that trap. By moving into building materials distribution and green energy tech, they are trying to improve their gross profit margins, which have historically been quite low, hovering around 5% in previous filings. If they can successfully integrate solar into their design and build projects, that margin profile changes significantly. If you're using Fidelity Wealth Management or have a dedicated account with Fidelity Investments, you're likely looking for more stable growth than SPHL offers. But for the more aggressive traders using the SoFi trading platform or the Robinhood app, these are the types of penny stock successes that people dream of. However, it is important to remember that the gap between an MOU and actual revenue can be months or even years. The market today is pricing in a best-case scenario reality that hasn't happened yet. They are betting on the potential, not the current state of the ledger. The future outlook for SPHL now depends entirely on whether they can convert this momentum into actual contracts. The pilot projects mentioned in the MOU will be the first real test. If homeowners in Singapore adopt these solar solutions at a high rate, Springview could see a legitimate revenue spike in the back half of 2026. If the pilots fail to gain traction, the stock will likely retreat just as quickly as it rose. The catalysts to watch for are the definitive commercial agreements that are supposed to follow this MOU. Until those are signed, this is a purely speculative play based on the expectation of a green energy pivot. The risks here are as large as the gains. We cannot ignore the fact that the company is still unprofitable and has seen its revenue decline in recent years. The reverse split saved the listing, but it didn't save the income statement. There is also the risk of further dilution. Often when a microcap stock sees a massive price surge like this, management takes the opportunity to raise capital by issuing new shares. This would be good for the company's cash position, but potentially bad for anyone buying in at 16 or 17 USD. Investors using interactive brokers or other professional-grade platforms will be watching the SEC filings closely over the next 48 hours for any news of a secondary offering. When we look at the sector momentum, we don't see this happening with other residential construction firms. This is a Springview-specific event. It highlights how a single piece of news can completely decouple a stock from its peers when the share structure is as tight as it is here. The reality of the market right now is that there is a lot of liquidity looking for a home, and when a story like Singapore residential solar hits a low-float Nasdaq ticker, the result is the vertical line we see on the chart today. In summary, the expectation for Springview was a quiet existence as a small-scale Singaporean builder struggling with Nasdaq compliance. The reality we are witnessing today is a company that has successfully utilized a reverse split to tighten its share structure and then dropped a major strategic partnership announcement into a market hungry for green energy stories. The result is a 600% gain that has caught the entire market off guard. We've seen a massive spike in volume, institutional silence replaced by retail frenzy and a total re-evaluation of what this company could become. Whether this new reality holds up depends on the execution of the solar pilots and the company's ability to turn an MOU into a profit-generating business. For now, SPHL is the clear standout of the day, proving once again that in the market, the gap between what people expect and what actually happens is where the biggest opportunities and risks are found. If you're looking for investment help or exploring online investing options, it's crucial to distinguish between a long-term trend and a single-day momentum spike. Stocks like Apple stock or Nvidia stock move on massive institutional shifts, while something like SPHL moves on sentiment and share scarcity. Whether you're using a SoFi robo-advisor or managing your own self-investing strategy through Fidelity Brokerage, always keep the expectation versus reality framework in mind. It will help you see past the 600% green numbers and understand the mechanics of the move. As we move into the final hours of the trading day, the question is where SPHL will close. Will it hold these gains or will we see a